Hey guys, James here with Waterford Business Solutions, continuing our discussion about taxes and tax forms. Over the past few weeks, we've talked a lot about business taxes with corporate returns, small business corporate returns, and partnership returns. But now we need to continue our business discussion and discuss your single member LLCs, your qualified joint ventures, and your sole proprietors. But to do that, we first must talk about the 1040 return or 1040 form, as that is what has to be filed in addition to the return for those businesses. Those businesses are filed on a Schedule C, which we will talk about next week. But a Schedule C is just an addendum, an addition to your 1040 return that you personally file. Now, most people in the U.S. are going to be very familiar with the 1040, as any U.S. citizen or person that lives in the U.S. under qualifying conditions must file that 1040 as long as they exceed income or age thresholds. Obviously, depending on your marital status, your filing status, and your age, breaks up where that is. But also, if you receive HSA or MSA distributions, had any self-employed earnings in excess of $400, even if you didn't meet those income thresholds as a total, or you made any advanced payments of your taxes, you still need to file this 1040 even if you didn't meet those income thresholds. So make sure that you are filing everything on these returns. Now, there's a ton of different things on these returns that we need to consider, and I'm going to go over some high levels, and one of those new ones is virtual currency. Virtual currency is growing in popularity significantly with Bitcoin and Dogecoin and so many other virtual currencies. And if you owned any virtual currency, you are required to inform the IRS of purchases or trades of that virtual currency, as it can be considered and will be considered for income and or for capital gains depending on how long you earned it. Now, for capital gains, we are going to talk about Schedule D in a few weeks, which will go into more explanation on that. The other thing to keep in mind with 1040s is you've got earned income and you've got unearned income. Earned income is going to be wages and things like that, which are taxed for federal income, Social Security, Medicare, and depending on your state taxes in addition. But then you also have unearned income like child support and Social Security benefits that you wouldn't have your payroll taxes, your Medicare and Social Security. And sometimes, depending on the income, you may not even have federal or state taxes on it. So it's very important to understand the differentiation between that and what qualifies for earned income versus unearned income. And that goes back to several of the other videos we've talked about as to how different types of businesses can affect your taxes and what you earned there. People always ask, do I have dependents? And a dependent isn't just a child. Any person that you are responsible for supporting throughout the tax year can be claimed as a dependent. And most of the time it is children under the age of 19 or 24 if they are a full-time student. But it can also be an aunt, an uncle, a sibling, your parents that you have living with you for the full year, and you are paying for at least half of their living expenses, and they have little to no income, so that you have to support them. So you can claim those older siblings, those older family members, as a dependent on your taxes. Now, children do have a higher tax credit than older dependents do, generally speaking, but it doesn't hurt still to claim if you have a dependent situation where you're taking care of your parents, taking care of a sibling, something like that, to claim that credit, even though it is less. Now, do make sure that you are following the rule to a T there if you are going to do something like that, and talk with an accountant who is familiar with your situation to best advise you as to whether you can claim that person as a dependent. Another common question is, should you itemize your deductions? Well, ultimately, it really depends. Everyone is qualified to a standard deduction. Everyone can claim it no matter what, and it doesn't matter. Now, you can easily claim more deductions. There's a ton of things that can be deductible. Mortgage interest, other taxes you pay for like state taxes or local taxes, keeping in mind those are currently capped. Vehicle registration fees, major medical bills or legal bills you can claim on there. All of that can be done. And there's a ton of other things like charitable contributions. But you need to make sure, A, that you qualify for deducting those things, and B, you've got the documentation to substantiate those deductions. Many people, while they could claim a ton of deductions on their return, they don't keep up with the documentation that would be required to substantiate these deductions. Keep in mind, the more deductions you claim, the more chance there is for you to be audited, especially for some off-the-wall deductions. So you need to make sure if you are going to claim some of these deductions, you keep the proper paperwork to substantiate it in case you are audited there. For most people, a standard deduction does make the most sense. There are plenty of people that you can claim tons of other deductions if we have the proof, if we have the data to substantiate those deductions. But please make sure that you are keeping track of that to protect yourself, because that's the whole thing with deductions, is protecting yourself. We also have tax deductions and tax credits. Now, I'm probably going to dig a lot further into this in either a future blog or a future video or both to go over that. You hear all the time about deductions on your tax returns. Well, a deduction is basically something that you're reducing the amount of income that you pay taxes on. So if you itemize your deductions by $1,000, $2,000, whatever, it will go ahead and reduce your income, what you earned, by that $1,000, $2,000, $3,000. Doesn't reduce your taxes by that. It just reduces your income. Now, depending on your tax bracket will depend on how that reduces your taxes. But all a deduction is doing is reducing the taxable income that you have. Now, a tax credit is a dollar-for-dollar tax reduction that you can take advantage of to reduce the amount that you're paying in taxes. So if you have a $1,000 tax credit, as long as you owe $1,000, you can reduce the money you owe to the federal government by $1,000 with that tax credit. But if you only owe the government $500, then you will lose out on $500 of that tax credit. So that's always important to consider when you're looking at tax credits, is how you can claim those tax credits, how they are going to affect you. What other things can you file with your 1040? And that list is numerous. There's so many, and we're going to go over a lot of them. But just a handful is going to be your Schedule C for business income that we'll be talking about next week. Schedule D's for asset sales, for capital gains. Schedule E for rental properties and royalties. Schedule SE for self-employment tax, which we will also talk about next week or the week after, because Schedule SE is almost always required to be filed when you file a Schedule C. So we're going to talk about all of that stuff together. Now, you can always e-file your return, mail your return in, use tax software, talk with people to file that return for an accountant. There's so many ways to file a 1040, and it is the most common one, so it is super easy to file in a myriad of different ways. But it's always important that you need to file, unless an extension is granted, your 1040 by the 15th day of the fourth month, or generally April 15th without an extension. If you want an extension, make sure you request an extension and do everything you need to for that extension, because that will extend it generally to October 15th. That is coming up fairly soon. So coming through here, if we don't file on time, what are the penalties? Well, if you're due a refund, there is no penalty for filing late. However, if you're due a refund, you have to file that return within 3 years of the due date. So if you're owed taxes for 2020, you file your return in 2021, April 15th, 2021, but you don't file that return and you're owed a refund, you have until April 15th of 2024. So make sure you understand whether you're owed a refund in order to claim that. But as a counter to that, make sure you also understand if you do owe taxes, you will likely incur penalties, and there's a myriad of those penalties that you can incur. So as always, guys, this is just a brief overview of 1040 and some different tips and tricks and big questions about it. If you've got more or want to talk specifically about your case, make sure to give us a call, shoot us an email. You can always reach us at info@waterfordbusinesssolutions.com or give us a call at 864-351-0852. Until next week, have a wonderful rest of your day.